Don't forget to like, subscribe and share the videos.
Hello all, welcome to the Ganesh IAS Academy, and the discussion is all about the previous year prelims question discussion. Let's start the discussion. This is also the pattern wise most easiest question, and also with basic understanding about what is monetary policy, what the RBI will do if there is inflation in the market. Okay, by that itself you can answer the question with the elimination. Okay, see, consider that with reference to the Indian economy, consider the following statement. Just look into the third statement. If the interest rate in the USA and European Union were to fall, that is likely to induce the RBI to buy dollar. I don't know. Okay, it's some of toughest statement. Okay, I have to think. Okay, I need a certain time period of more than 1 minute to think about this statement. Okay, let's discuss the second statement. If the rupee is rapidly depreciating, the RBI is likely to sell the dollar in the market. This statement is little bit easy one. Let's go into the first statement. If the inflation is too high, okay, the RBI is likely to buy the government security. This is one of the easiest statement. Okay, so the first statement is speaking about open market operation. Okay, if there is a high inflation in the market, which means money supply is higher. Okay, in that time what the RBI will do is they will sell government securities and get back the money from the market. Okay, so if there is a inflation in the market, means that higher money supply in the market. Okay, so what the RBI will do is they will just sell the government securities and they will just pump out the large money in this market. Okay, they just pump it out. Okay, by that they will reduce the inflation in the market. Okay, so if there is huge inflation, means they will sell the government securities to reduce the inflation. Okay, this is opposite will happen in if there is a low inflation or a deflation in the economy, they will just buy the G-Sec and they will pump in the money into the market. Okay, this will they do. Just look into the statement first. If the inflation is too high, RBI is likely to buy the government security. No, it is actually sell the government security to reduce the inflation. Okay, so by that itself the first statement is wrong. Okay, by eliminating the first statement you can directly go to the answer as B. Okay, so answer is actually 2 and 3, but we have to discuss how the statement 2 is correct and also how the statement 3 is correct. Okay, that thing we are going to discuss. See, one of the easiest question, because you can easily eliminate the statement, and also the statement is very much easier. Okay, the eliminated statement is much more easy, so you can easily eliminate it and you can get into the answer. Okay, let's discuss the second statement. If the rupee is rapidly depreciating, okay, so if there is a rupee is rapidly depreciating, the RBI is likely to sell the dollar in the market. What is mean by depreciation? $1 is equal to 50 rupees. Okay, that becomes $1 is equal to 100 rupees. That is called as depreciation. The value of the domestic currency is decreasing. Okay, which means earlier with just 50 rupees I can buy $1. Okay, but now I need to have 100 rupees to buy a $1. Okay, which means I need more currency to buy a $1. Okay, with just 50 rupees I can buy $1 in the first time period, but now I need 100 rupees to buy same $1, which means that is called as depreciation, or the value of the domestic currency is going on downwards. Okay, that is called as depreciation. Okay, that is called as depreciation of the currency. Okay, so in this scenario what the RBI will do? Okay, the RBI is likely to sell the dollar in the market, which means consider that RBI have the forex reserve, okay, in which they have a dollar, euro, pound, sterling, okay, all foreign currency as a reserve they will have, okay. So when there is a huge depreciation in the market, they will try to sell the dollar, because why they are selling the dollar means they are actually showing that we the Indian economy don't need a dollar, okay. By that they are trying to devaluate the dollar, okay, devaluate the US currency. So if you are going to devaluate the US currency means that itself makes the appreciation of the Indian currency, okay. So that is the basic idea behind behind the selling of the dollar, okay. So all this thing is all about revaluation of the domestic currency. So what the RBI is trying to do is revaluate it, okay. So they are trying to appreciate the currency, appreciate the domestic currency. To make the appreciation of the domestic currency or else revaluation of the domestic currency, they have to devaluate the foreign currency, okay. So for that they will sell the dollars in open market, okay. By that itself Indian currency as $1 equal to 100 rupees may change from $1 is equal to 50 rupees, okay. Again it is getting back into the normal scenario, okay. To overcome this depreciation, they will do some revaluation activity, okay. That revaluation activity is nothing but selling the US dollar, okay, selling the US dollar in the open market, okay. By that itself they can revaluate the currency, revaluate the domestic currency, okay. This is the basic idea, okay. So the second statement is correct. Consider the third statement, okay. If the interest rate in the USA or the European Union were to fall, okay, that is likely to induce the RBI to buy dollar, which means you can take whatever scenario, okay. I just took a scenario as the interest rate of the government securities of the USA or as the government securities of the European Union that is falling, means the investors invested money in the Federal Reserve will just get back their money from the US Federal Reserve because the interest rates are falling, okay. So the return of money they invested in the US market will be reducing, okay. In such a scenario they will try to get back their money, okay. That is called as capital flight, okay. So they will get back the money and they will source another economy to invest, okay. So if there is a outflow in the US economy, means that will create an inflow in the Indian economy, okay. By that the RBI have to buy more foreign currency and they have to exchange it with the rupees to invest in the domestic economy, okay. So if the investor is going to invest in India, they will come with the dollars and they will get the rupees and invest in the domestic market. Domestic market means Indian market. So by that if the interest rate of in the USA or European Union were to fall, that is likely to induce the RBI to buy dollars, okay. So this is the basic idea, okay. So by that you are coming to know that answer is 2 and 3, okay. Let's discuss about the source of this question. So how can the RBI rate hike help stem the rupee slide, okay. In this article they clearly spoke about what are the things will happen if there is a depreciation in the rupee, okay, how the RBI will manage it, and also they spoke about the interest rate downfall in the US Federal Reserve, means what will the impact or what are the repercussions in the Indian market. Okay, so the source is all about this question. Okay, the source itself have all these three statements within that. By that they ask these kinds of questions. Okay, see, this is one of the easiest question. With the elimination of the statement 1, you can easily get into the answer. Okay.